Hello, everyone. We're going to wait about 30 seconds longer because people are still filtering in, and then we'll get rolling.
All right, I think we're looking good, Dave.
Great. Well, greetings and welcome, everyone. We're so happy you could join us. We have a lot to talk about today. We're going to cover a wide range of topics. First off, you're going to be hearing from our Chief Investment Officer and partner, Yusuf Abujaderi. You'll then also be hearing from our other partner and Chief Planning Officer, Lauren Stansel. And and just to note, this will be recorded. So if you have friends or colleagues who you think might benefit from it, we'll be probably send you the link tomorrow or possibly this afternoon. Take it away, Yusuf.
And I'm
And
gonna,
before I start, Lauren, yep, go ahead with some logistics.
yeah, I was just gonna dive in just to respond to one question, as Dave just said. Yes, we are recording. We'll send out a link. It'll be available on our website. If you are at any point have a question, feel free to use the chat where you can chat directly to us or to everyone here. Feel free to use the Q&A session. One thing we would love to do is just hear where everyone's chiming in from. Where are you tuning in from? Feel free to chat in the chat to everyone where you are listening from. We can see where people are right now, what time zone it is, and then at any point questions go in there. And additionally, any questions that we can't get to for any reason during the webinar, we will compile all of them and answer all of them and share those as well so everyone can see those answers. And with that, I will turn it over to you, Yusuf.
Thank you, Lauren. So, agenda. Today we'll start with a review of where markets and the economy are year to date. No shortage of content to cover in that space, and yet we're going to try to keep our comments brief here, maybe 15, 20 minutes in that segment, and then leave the rest of the conversation for our second subject that we've noted here, focusing on how you can build resilience through financial planning, controlling the controllables, as it were, seeing as neither I nor Dave nor anyone else here has figured out how to control the entire stock market. And so, with that being said, we'll dive in, and the initial focus of our comments on markets and the economy, right here. If you've been watching TV, if you've been consuming any type of financial news, if you've been sentient for the last 2 months, you've probably heard the word tariffs more times than you can count. It's been a bit loony out there, for lack of better phrasing, or maybe that's appropriate given what we're looking at. Here's the long and the short of it, and then we'll move on from this slide. At this point in the tariff story, you'll see, if there's good news or better than expected news about tariffs being eased, trade agreements being struck with, the U.S.'s major trading partners, that's going to be a tailwind for markets. You'll see markets likely respond favorably. And then, of course, the inverse is true. And we're getting updates of this type. I'm going to move off this slide now. Even through last night, President Trump easing off comments about how intense the tariffs against China are going to be. Other members of his cabinet talking about the current rate being unsustainable. And overnight, markets have been reacting favorably. Today, we've seen positive returns thus far through the days.
Also note, he also said that he was no longer hoping to fire Fed Chair Powell, which I think was a huge part of why the markets rose this morning.
Absolutely. I mean, we saw a really tough performance or tough movements in markets on Monday, mainly in President Trump was going to be focused on getting rid of Chairman Powell as soon as possible. And of course, backing off of that, Dave, as you just said, markets have reacted favorably. So what we're showing you on this slide is the roller coaster you've been on year to date. 3 lines, the red line being that of the S&P 500. And let me grab my annotating tool here. But the red line being that of the S&P 500, down about 10% through yesterday. The blue line being the All Country World Index, that's our benchmark. And that's what we judge our performance against. So global stocks around the world year to date down about 5%. The Yeski Buoy portfolio of stocks through yesterday down about 3.6% year to date. And so you can see how nasty the trip in early April was once Liberation Day came and went and reciprocal tariffs were announced. Prior to that point, we just wanted to make note, the Yeski Buoy portfolio through the first quarter was slightly positive, had weathered the initial round of tariff news really well, and we think has continued to weather the storm very well, certainly better than the other indices that we're showing here on this slide. This is what your portfolio was designed to do. Deal with information as it comes in. You're in a broadly diversified mix of stocks all around the world of different shapes and sizes. And broadly diversified basket of investments should weather uncertainty well. And that's what we've been seeing over the course of the beginning of this year.
And Yusuf, you've been doing a good job of saying the Yeski Buoy stock portfolio, because pretty much every client also has cash and bonds, right?
Absolutely. And on that note, bonds are up anywhere between 1% and 2% year to date. If you're invested in the money market fund of our preference, Schwab's Premium Money Market Fund, it's currently yielding 4% as well. So aside from the stocks in your portfolio, bonds and cash are serving as a bit of a buoy, no pun intended, but keeping the portfolio upright as we navigate these uncertain waters. So we'll move along to another image that we came across in preparing for this presentation. And Dave, you had mentioned you wanted to make sure this particular point was part of our today. What I'll share, and then I'll cede the floor to you. Typically what we see in times when stocks are on a downward swing, that you also kind of see, the dollar rise, that you see the 10-year Treasury yield rise. In fact, in this particular case, we've been seeing the opposite. On the left-hand side of this chart, the green line, that's the 10-year Treasury. Ignore the spike upward on the far right end of that chart. That happened after tariffs were paused. Prior to that,
I would say, the spike in yield actually means the prices went down. So this was
right.
This is very unusual to see the price of Treasury bonds go down and the value of the dollar go down, because both are normally a safe haven. And this time,
right.
when it comes to a flight to safety, suddenly the United States didn't feel so safe.
Yeah, and even through yesterday, you were hearing about the sell the U.S. trade that was becoming more and more popular, which, and thank you for shaking your head no, Dave, of course, that's not a direction that we're going to be going in. We continue to believe that maintaining a globally neutral portfolio is the way to go. Maybe one more note to make on this particular image, and focusing now on the chart on the right, a decline in the strength of the dollar is not all bad as it pertains to our clients' portfolios. For those of you who have tuned in to these webinars in the past, you know that we do not hedge against currency rate risk in our portfolio. So what that means is your international holdings, when we convert those returns back into dollars, that ends up coming out at a higher rate if the dollar is weaker, as we've been seeing in recent months. So, it pays to be diversified in so many ways, and yet another way that we just mentioned here on this slide.
Right. Seeing the yellow line go down literally means that the returns on your international holdings are going up. It's like a mirror image. It's really, it's something we've been waiting to see, because the U.S. market and the U.S. dollar have both been really strong in recent years, but we continue to believe that global diversification made sense. And in the last 3-4 weeks, boy, has it really come through.
Absolutely. Absolutely. And so, in times like these, what we're going to say, And yet we're going to say it anyway. Keep calm and carry on. Again, you're in a portfolio that is built for turbulence just as much as it's built for clear skies. And so far, so good this year in terms of dealing with what has been thrown at markets and the economy overall.
And Yusuf, I think
Yeah.
you're making this point right now, but just to ask it, verbatim from a question that came in here's, given the ongoing market chaos, which shows little sign of abating, has your equities investment strategy changed?
In a word, no. One of my favorite presentations that we've ever done on our portfolio, on our investment philosophy, Dave, this is from 10, 12 years ago, the all-weather portfolio presentation that you'd put together. This is a portfolio that's designed for all seasons. It was designed for all seasons when it was put together. We review it continuously. We take in new information as it comes in. And we very much believe that being globally diversified with a tilt in favor of small company stocks and value stocks is an approach that's going to serve you well, no matter the season, no matter the weather. The image here that's serving as a backdrop to these comments, and I'll pause in just a moment, Dave, but the image that we're showing you, the dark green area is the performance of all of the portfolios, all the accounts we've ever managed as Yeski Buoy over the past 30 years. The tan area or the lighter area is the performance of the benchmark. And so the outperformance that we've observed over 3+ decades, we think is a direct response or a direct cause directly by, again, having a diversified approach, but again, tilting in favor of premiums that we have seen be prevalent and pervasive throughout market history. And then, of course, being disciplined and rebalancing. So we're not changing the philosophy. We're capitalizing on opportunities to buy low and sell high. But no changes to the investment philosophy. Dave, what would you add?
Well, the only thing I'll add is that we are very similar to the benchmark in that the benchmark is global, and we too are global, and that's why we think it's an appropriate benchmark. But as Yusuf was just saying, the key difference is that we overweight small company stocks relative to the benchmark, and we overweight value stocks. And so the difference between the light green and the dark green is really the premium to value in small company stocks. The second thing I'll say is the benchmark tripled in value. This is like it didn't do nothing. The benchmark tripled in value. Now, our portfolios happen to have increased 9-fold, which, we're gratified by that. But if you were just invested in the All Country World Index, you still tripled the value of your portfolio over that period of time. But to get that supercharge, you had to overweight those areas of the market that we know, as a consequence of a lot of economic research, is priced for higher returns, and that's small company and value. And this is why, even though value in small company doesn't beat the rest of the market every year, we know that over the long run it does, and this is the proof of that. We talk about probabilities. In any given year, there's a 60% chance that small company and value is going to beat the rest of the market. But that means there's a 40% chance that it's not, and that's non-trivial. But if you had to play the odds, would you go with 60% or 40%? We go with the 60%, and it doesn't work every year, but as you can see, over the course of 30+ years, it does. And I'll leave it at that.
Well, and it's a perfect segue to make the final point for this slide, which is, we've been doing this for some time. And while what we've been going through at the beginning part of this year has certainly been unnerving at times, and I don't mean to dismiss the significance of the experience that we're going through, but if we look at a 30-year period, this shows the first quarter of 2024 doesn't quite capture the last 3 weeks because we report on our composite performance quarterly. But this is what we're looking at relative to, again, if we're going to use the roller coaster analogy, the ride we've been on for the last 30 years.
And I'll just say there was a question about whether or not this was inflation adjusted, and it's not. These are nominal returns. But I will say, inflation adjusted or not, the Yeski Bui portfolio grew 3 times as much as the global benchmark. So whatever the inflation rate was, you're better off having been not only more diversified, but tilting towards small in value.
Absolutely. Last slide in this segment for me before we kick it over to Lauren. Tweets to take home. And we know it's not called Twitter anymore, but perhaps a bit of fun, maybe even a little bit of innocent civil disobedience. If we leave you with a few ideas to take with you, as we were just saying, we tilt the portfolio in favor of value. Value stocks have been outperforming their more expensive counterparts, whether you're looking at U.S. large company stocks, international large or international small. On average, the value component of your portfolio is outperforming by 4% year to date. So we love seeing that. In addition, international has been beating the U.S. And of course, as we've mentioned multiple times today, you have a global mix of stocks in your portfolio. International ahead of the U.S. year to date by 15%. I checked again this morning because I couldn't even believe the statistic. But 15% international over U.S. year to date. A couple economic numbers or economy numbers to keep with you. You may have seen the headlines, the projection for the first quarter of economic output as measured by gross domestic product, GDP, annualized at -2%, which means that it's estimated in the first quarter it went down by about 0.5 point. I'm not trivializing that, I'm just contextualizing the information. The most recent inflation reading, 2.4%, edging closer towards the 2% goal of the Fed. Of course, that's before any effect of the recent tariffs have come into play, but in a healthy spot as of the most recent reading. The same true for unemployment, clocking in at 4.2%, of course, 4% constituting full employment. So overall, healthy economic numbers in spite of everything that we've been hearing about in the news. And finally, in terms of something to look forward to, the Fed gets together again in early May and again in mid-June. Currently, the federal funds rate, the baseline interest rate is at 4.25%. We'll see if there are any cuts made over the next couple of meetings. But right now, the Fed has been holding steady. And so with that, enough out of me. On to you, Lauren.
I'm not going to let you off the hook yet. There's one question I'll chime in here. And if there are others, please feel free, chat them, add them in the Q&A. We can always come back to questions if they come up, and we'll circle back at the end. But just one here, Yusuf, you were talking about the US dollar and international returns, but that also is affecting some people who are traveling overseas, maybe making vacations a bit more expensive, and curiosity if there's anything to be done there, any advice, or is there anything that can even be done?
I mean, thinking proactively, as obviously our questioner is doing, is the number one thing you can do. And then making sure you're capitalizing on whatever the exchange rates are, depending on where you're traveling. Dave, if you want to add anything there as well.
I guess the only thing I would add is because these exchange rates are fluctuating on a daily basis, I tend to favor using credit cards rather than just like exchanging a big chunk of cash. Using credit cards on a day-by-day basis while I'm traveling and getting the exchange rate of the day, so to speak. It's not good now. I like to think it's not going to get worse. I mean, the dollar's fallen quite a bit. But I think that's what I would do, is just be a little bit dynamic in my spending by using credit cards.
Yeah, take control.
And we've got one more great question coming in now, just from a prior webinar, someone who has attended past webinars, watched them. You know, we talked in the past about how often our government is designed to make things change slowly, or maybe certain aspects change slowly, but it's feeling more like a steamroller. Any commentary there?
Dave, I'll defer to you if you want to jump in first. Just caught you in a cough.
Thank you. Yeah, caught me in a cough. There's no question that the first 100 days, and I know we're beyond the first 100 days by a little bit at this point, The first 100 days of this administration have been more tumultuous than almost any we've seen in a century. And I think that was by design. I don't think the chaos was by design. I think that the level of activity was by design. And the only, I guess, the comfort I take from recent events is that it appears that, you know, opinion polls come in periodically. They drift in, and they're usually backward looking when it comes to opinions about economic competence and various other things. But the stock and bond markets give daily feedback, and it's daily unambiguous feedback. And it seems like even though the initial opinions of the market were being ignored a few weeks ago, it appears the administration is now paying attention to that instant feedback more. And I think we saw that in President Trump walking back his remarks about Fed Chairman Powell and getting immediate positive feedback from the market. So I'm hoping that what we're seeing is the administration kind of tuning into that instant feedback from the stock and bond markets, and that will moderate the chaos in the coming days and weeks and months. Yusuf, anything to add to that?
Just that I read a headline today that said Trump is feeling the market or starting to feel the market. And so just underlining what you were saying, I think that's becoming more of a consensus view.
So thank you, markets. Thank you, markets, for giving instant, minute by minute, day by day feedback that hopefully is going to have an impact.
And I will, well, I was going to say this later. I'm sure I'll repeat myself again, but just acknowledging that, you know, we are a positive bunch. We have a pretty good outlook on many things. And that's not to diminish the fact of how things are feeling. It certainly does at times feel like a steamroller. It can feel scary, terrifying, exciting, whatever emotions people are feeling are completely valid. And we fundamentally believe that we'll all get through it. And so that's where you hear a lot of positivity from us. And it's not to ignore the fact that things aren't chaotic or, you know, insert adjective here. So just wanted to share that. And you know, I'm sure I'll repeat myself later because I was planning to say it later. One additional question so far, and I'm keeping an eye out. If there are more, feel free to type them in. But coming in on the Q&A here, are you worried that the dollar will or could cease to be the world's reserve currency?
No.
No, that would be my answer. I mean, the thing is, the administration has been doing things in these first 100 days that have damaged the standing of the dollar. But it's one thing to say the dollar standing has been damaged. And it's another thing to look at all the alternative currencies, and nothing comes close.
Right.
So I'm not saying we have forever, but we have a while before that's going to become an issue. Do you agree, Yusuf?
Completely agreed.
All right. Well, I'll keep an eye out, like I said, for more questions. We can always circle back, but we'll shift into some financial planning updates. First, just want to share a bit of what we're working on, what we're paying attention to, things that have been on our mind. And then we have some celebrity appearances here for some updates on the California insurance market from Sydney and the current status of the student loan landscape from Ryan. So they're going to join us here on camera now and chime in on some areas of their expertise. And then circle back to just the things that we can control, what you can control specifically in your life, what we think can be controlled, because those can be really great sources of grounding during times of chaos. So we'll move into some of the things we're working on. Many of you are probably happy that tax day has come and gone, or at least extension day. I know we've got at least one tax professional here today, and so certainly hopefully got some good time off. But we've been focusing, of course, a lot on taxes the last couple months, whether that was sharing tax documents from Schwab with tax professionals or clients for those tax returns, helping with any tax payments for taxes due or those Q1 estimated tax tax payments or extension payments, combining the two, and then actually asking for those tax returns. So now that they're filed, you'll start seeing some requests come in from us over the coming months to share those tax returns with us, because there's a lot of financial planning that is really helpful or helped by having those tax returns. And we'll talk a little bit about that. And I'm going to go out of order and share that we are working with some really new extensive tax planning software. We believe it is very important that all of our financial planners have significant understanding of taxes and how they work, how calculations work, how the tax system works, how income is taxed, how it all fits together in the puzzle of taxes. And this significant tax planning software is going to help us be really confident in the numbers and the calculations for what different tax strategies might look like, and help us collaborate really well with your tax professionals on things like Roth conversions or looking at your required minimum distributions and qualified charitable distributions. The other thing that certainly as one of the resident tax nerds, I am paying attention to are constant tax law changes. I have had a lot of experience with those tax law changes over the last 6 years now, 5.5, 6 years, and surely we've got some updates coming. The TCJA is the Tax Cut and Jobs Act. It was enacted by President Trump during his first term, and it's set to sunset at the end of this year. So there are over 30 provisions set to sunset. California clients, you may think a lot about the SALT deduction, state and local tax income that's limited to $10,000, different tax rates, the estate tax exemption, a lot of pieces that are set to sunset. But as you've heard in past webinars from me, it is sounding like potentially the most likely is an extension of those tax cuts. That is what President Trump has indicated he would like to do. He'd like to extend the TCJA indefinitely. What they're looking at right now in the House and the Senate through budget reconciliation is extending it through 2034. And the current projected cost of doing so is about $4.5 trillion. And so in looking through, they're figuring out through this budget reconciliation process how much deficit funded tax cuts may be acceptable and may be able to pass through both the House and the Senate. So that's something I'm paying attention to. If and when there are final decisions that, we'll see, because they have till the end of the year, and I'm hopeful they'll do it proactively, not retroactively. But when there are final updates there, you will hear from us, both webinar and article format, about what's happening, what's changing, and any actions anyone may need to take. And then, of course, if you are one of the people who may need to take action, we'll coordinate with you and your tax professional, make sure we've got all the players involved on what may need to happen. So a lot of tax stuff that's been big on our mind. Both Ryan and Sydney deeply involved in that tax planning work, and all of our financial planning team on the work we've been doing and what's to come the rest of the year around taxes. And next, what we also are thinking a lot about in this time frame, this time of year, are retirement accounts. So again, I'm going to go out of order in my bullets and talk about those distribution plans. We've been working on distributing required minimum distributions for clients. So whether you have been taking required minimum distributions for years, or this year you turn 73 and it's the first year of your RMDs, we've been connecting with clients on getting those distributed, whether it's to support spending or monthly distributions or waiting till later in the year. And as part of that, also qualified charitable distribution. So if it makes sense to be doing charitable giving from your IRA as part of your RMD directly, we're coordinating on those. Now, it's kind of crazy to say Roth conversions, because usually that's part of our year-end tax planning process, but it is April 23rd, and the year-end tax planning, I think, will be here before we know it. We will blink and it'll be time. And so that's one of those reasons that having those tax returns every year is really helpful to us, to make sure we have your most recent information on file. We know what the moving pieces are, and we can do an accurate Roth conversion analysis and then work with you and your tax professional to see if it could make sense and if there are lower tax years to take advantage of. And then one thing I'm going to repeat from the last webinar, Yusuf, if we can go to the next slide. For anyone who was here, this is the identical slide I had. For anyone who wasn't, I think it's important to know these numbers because there are some new changes this year, or just some updated numbers. So the contribution limits for retirement accounts for IRAs is $7,000 for everyone. If you are over 50.5 at the end of the year, catch-up contribution of $1,000, so $8,000 total. The one that is a pretty big change, in my opinion, from paying attention to these contribution limits every year is the employer retirement accounts. So the annual elective deferral maximum this year is $23,500. And there's the usual catch-up contribution that has kind of always been around that we talk about. If you're if you're over 50, it's $7,500. So in that case, you'd be able to contribute $31,000 to your 401k, 403b, 457 in a given year. However, right now there is this special contribution, catch-up contribution period, where if you are between the age of 60 to 63 at the end of this year, so as of 12/31/2025, your catch-up contribution is actually $11,250. And so you could put away up to $34,750 into that employer retirement account this year. Now, one thing to pay attention to, and we will see what happens with the tax law changes and what parts of various past tax law changes stay in place. Right now, the plan is, and what is coming is in 2026, if you are a high income earner and you earn more than $145,000 a year, and you make catch-up contributions to one of these employer retirement plans, your catch-up contributions will be after tax. So they will be taxable and they will go into a Roth account. Your regular base contribution will go into your traditional tax deferred, if that's how you have it set up, 401k. Any employer match goes into the tax deferred piece, but your catch-up contributions will be required to go into Roth, and you'll pay tax on those dollars. So that's something that's coming next year that your employer will take care of in the background with the 401k plan, but good to know. So I have a question here that's coming in. I'm going to read it because it's related to taxes, and it's a good one because it's about tax planning, estimated tax payments, about getting those Schwab 1099 forms. So those are the tax forms that come from Schwab in February and March. And whether we can do year-end planning to share if there is a significant capital gains year, can we share that information end of year or early in the year to make an estimated tax payment in January? And the answer is absolutely yes. We can certainly send tentative year-end data close to the end of December and then year-end data in early January, so that if an additional tax payment is needed for any fourth quarter income, that can be made by January 15th. So I will note that down, and specific to this person who asked, I will make sure that we touch base on that. So if there are any tax questions, obviously we'll continue to pay attention to what is going on in the tax landscape and all the financial planning landscape. But with that, I will turn it over to Sydney for an update on the insurance market.
Thank you, Lauren. And I'll start by just noting that I know this slide says the California insurance market crisis, but we think that this is really valuable for all of our clients. We'll be providing some context on what's currently happening in California, but also there's a couple of housekeeping items at the bottom of our slide that we'll want to go through that I think apply to everybody. And so with that, we'll start with an overview of what's currently happening in California. So to start, insurance carriers are leaving the state. And when we refer to insurance carriers in this context, we're really talking about what are called admitted carriers. So those are the ones that are the names you're hearing on a day-to-day basis, like State Farm or Travelers. The why behind this is mostly related just to the high risk of the state of California in terms of wildfires and the rising cost of, replacing items and homes and other buildings that are damaged due to wildfires. And it's just become a strain on the insurance companies within the state. A lot of this strain is related to a rule and law in place in California by the state commissioner for insurance, who has set a standard of no more than 7% insurance premium increases for all admitted carriers. And so really that's limiting what homeowners are receiving in terms of increased premiums. But because of the high number of wildfires, specifically in the past 10 years, the cost to replace all these items has put a strain on the insurance companies. And thus the companies are leaving the state because if they can't cover the risk that's associated with, insuring homes in the state of California, they have to make that business decision. And so they've been leaving. So if you are unrenewed or non-renewed for insurance through an admitted carrier, the next step is what we call a non-admitted carrier. And so those are still big insurance companies, but not the names that you hear from a day-to-day basis. So Lloyd's of London would be a good example of one of those insurers. And what's different for them is they're not subject to state law in terms of what prices they're allowed to set for insurance premiums. So they don't have to keep insurance premium increases to that 7%. They can really model out what they'd like that cost to be based off of the risk each individual homeowner is presenting for their policy. And so again, they're typically more expensive. Again, if you're not able to get a policy through an admitted carrier and you've been transitioned into a non-admitted carrier, probably going to be paying more premium. And the deductibles are pretty often more expensive or more high. But you're still getting an overall comprehensive policy through one of those non-admitted carriers. What tends to happen, though, and what we've been seeing recently is some of these non-admitted carriers are also not admitting new homeowners into their policies. And so you're being transitioned into what's called the FAIR Plan. And the FAIR Plan stands for Fair Access to Insurance Requirements. It's a state mandated program, but it's not state funded. And so what that means is all the carriers in the state of California are required to siphon off a portion of their premiums that they're collecting to put into this FAIR Plan fund, if you will. And that policy is to cover, again, all those individuals and homeowners who can't get a policy through a traditional mean. And this coverage is really minimal. So it really only covers fire coverage and nothing else. So it's not providing you any liability coverage. It's not providing damage due to water or theft or anything like that. And so while it's better than having no homeowners insurance, it's not the ideal option. And again, there are some ways to get some additional coverage, adding in additional policies, but it's becoming a concern that a lot more homeowners in the state of California are being subject to the only policy being the FAIR Plan. And the concern for this is beyond just the lack of coverage it creates. We've also been seeing a huge liability within the FAIR Plan with more homeowners using this insurance. So as of September 2024, the FAIR Plan had about $400 billion in exposure for risk, but only $3 billion in cash reserves, meaning that one big fire would essentially deplete their entire reserve. And so, as we know, if we jump to this next section of the aftermath of the LA fires, go back one. Thanks, Yusuf. So if we think about January of 2025, we know we were devastated by the LA fires. Those fires were ranked in the top 5 most destructive fires in California history, based on, in terms of the cost to repair and rebuild the city. Total costs are still being determined as things are unfolding, but estimates are of about upwards of $45 billion. If we look specifically at what the FAIR Plan was covering in those homeowners, the coverage is at minimum $4 billion of exposure risk of the affected homes in LA. And again, in September of 2024, they only had $3 billion in cash. And so in February of 2025, the FAIR Plan released a statement that they were going to run out of money by March. And so a special charge of $1 billion was put onto the insurance companies. And a piece that I forgot to mention earlier, the way that the FAIR Plan is funded, again, is by all of the insurance companies in the state siphoning off those premiums. And so when this $1 billion charge was passed in February, that means all of the homeowners who have not been non-renewed, so who still have policies through State Farm and Travelers and Farmers and insurance companies similar to that, they're now seeing a jump in their premiums as well, because the insurance companies have to siphon off and provide coverage for FAIR Plan, provide that funding. And so the homeowners are getting that increased policy premium. And so you will probably see a jump in your premiums if you haven't already, and you live in the state of California. So again, a lot of this is still unfolding with the LA fires, and the reality is certainly with this $1 billion special charge, you'll see an increase. But in general, there's just a it's unsustainable for the insurance market in California to continue in the way that it has been. So we've seen some legislation, and our insurance experts that we work closely with have been sharing a bit about some things that are in the works, one of which being the sustainable insurance strategy. And so that strategy would move to remove that 7% max premium increase. But it would also require those insurance agencies to provide coverage in high fire risk areas. So providing more coverage and having the insurance company stay in the state, but most likely increasing premiums across the board. It's interesting to note that actually California has some of the cheapest homeowners insurance policies. I know that it doesn't feel that way to most of us, but the premiums in comparison to the rest of the nation are fairly low due to this longstanding 7% rule.
Interesting.
so-
And isn't it also true that elsewhere in the country, the East Coast, for example, are seeing that the magnitude and frequency of really bad storms, hurricanes, et cetera, has increased and thus also put pressure on property and casualty insurers?
Yeah, that's a great question, David. It's a great point. Specifically in Florida, we've seen a lot of similar movement in Florida. There's other states as well, certainly in the tornado zone and other states that are experiencing large weather. This is similar. Yeah. And so just with that, moving on to one of the things that we have noted, and insurance agents have been telling us as they've been keeping an eye on the aftermath of the LA fires, is there have been some claims being denied for individuals who have homes that are titled in the name of their trust, but whose trust isn't listed on their insurance policy. And so this is, certainly a huge issue. We certainly feel for everyone who's currently experiencing this, and we wanted to just bring it to everyone's attention. A housekeeping item that is really important for anyone in California, but to Dave's point, also really important for every client or individual who's on this call to consider. So the steps to take there is first, reach out to us. If you're a client of ours, connect with us and we'll help you determine if it makes the most sense for your home to be titled in the name of the trust. We can help you talk about different ways to confirm all these steps. So reach out to your financial planning team first. From there, you'll work with your estate attorney to, if we determine that the recommendation is to title your home in the name of your trust, you'll work with your estate planning attorney to get that transfer set up, and then you'll connect with your insurance agent to make sure that your trust is added to your homeowners. And then again, connect with us at the end, and we'll make sure we have all of our records in place so that we know you're in good order going forward. So I know that was a lot of information, but I'll pause. If you have any questions about your specific situation, feel free to reach out to us individually, or if you have general questions, we'd be happy to answer those here.
Yeah, I'll keep an eye out. We've got some comments here just about people going through this experience. And one thing I'll add is that, the FAIR Plan is certainly coverage if you need it, but it is the last resort. If you can get coverage through the secondary insurers, it will be more expensive, but it is better coverage with better companies with less risk than the FAIR Plan. And so one of the pieces that I would note is that the second that you get a non-renewal notice, reach out to us. We have some incredible insurance experts we've been working directly with who can go out, get quotes for you and see what are the options available to you and how do they compare. And so, the easy answer might be, oh, I'll just go to the FAIR Plan, I'll get this, it's way cheaper than anything else, but it really is the last resort. And if it is the only option, it is absolutely better than nothing. There are, Sydney, correct me if I'm wrong, I believe they're called DIC policies, difference in conditions, that you add on top of the FAIR Plan to get the other coverages that you need to have complete homeowners insurance that includes the fire, but also all of the liability and personal items for other occurrences. So I think the number one step here is the biggest one. Connect with us with any questions that you have specific to your situation. We will help you make sure that everything is either set up correctly with regards to these steps in the name of your trust, or help you get connected with the right professionals if you get a non-renewal notice or you're buying a new home and you're having trouble with insurance pieces. Reach out to us so that we can help. And I'm not seeing any other questions at the moment, so I think we can move on to the next step. But again, if questions come up, let us know, we can circle back.
All right, thank you. So the student loan landscape is changing quickly. It feels like there's a headline every day about student loans, the Department of Education. So let's check in. What's going on? What are we hearing in the news? We're hearing a lot about the Department of Education. Is it being shut down? We're hearing about student loans, some being referred to collections. What we'll talk about what that means. And is this the end of student loan forgiveness as we know it? So we'll hit on each of these in order. We'll start with the Department of Education. Back on March 20th, President Trump issued an executive order. Many people have taken that to mean that this would immediately end the Department of Education, but in reality, that order simply directs the education secretary to begin planning for the agency's closure. Of course, any other changes must be implemented via an act of Congress. Um, these changes continued with mass layoffs. These layoffs are still currently in litigation, so it's possible that some of these jobs end up coming back. And anything else that we hear people talking about, like freezing funding for certain programs, adjusting school curricula, which has to take place at the state and local level, or even moving student loans under the umbrella of the Treasury Department. All of these we should look for through the acts that Congress has been taking. And 4 bills, 2 in the Senate, 2 in the House, have been introduced in Congress to terminate the Department of Education, but no further progress has been made, and we're not really seeing any real energy toward actually pushing for that to become a reality. So really, there are two primary impacts to what we're hearing around the Department of Education. The first is uncertainty for many school districts regarding whether they can rely on funding for things like the Child Nutrition Act, students with disabilities, or schools in low-income areas. And a secondary impact is for student loan borrowers, there is an enormous backlog of income recertification applications and borrowers looking to get back into repayment plans after not having paid for 3 or 4 years. One employee who was let go from the department in March reported leaving behind a pile of 16,000 student loan borrower complaints. And the Department of Education has more than 1 million borrowers who have applied for an income-driven repayment plan and are still waiting to be approved. So expect delays, expect backlogs. This is why you'll hear us say a few times, it's best to be your own advocate and keep clear and accurate records. The next 2 points really go hand in hand. There are currently 38 million total student loan borrowers, and estimates are that 5.3 million borrowers are currently in default, which means they are 9 or more months behind on payments on their student loans. And another 4 million borrowers are 3 to 6 months behind, meaning that up to 9 million borrowers could be in default by the end of this year, which would be a record number. Right now, less than 40% of all student loan borrowers are current on their student loans. And so when we think about borrowers in default being sent to collections, this is really a change from what we've seen over the past 4 or 5 years because no loans have been referred to collections since March of 2020 when the state of emergency was issued due to the COVID-19 pandemic. Since then, student loans were in forbearance, meaning no payments were required, but interest was still accruing for about 3 years until 2023, at which point then President Biden added another 12 months by basically saying, okay, you do have to make your payments now, but we won't report you to the credit bureaus if you don't pay. So essentially, they reinstated the requirement to continue paying, but there were no consequences if you didn't. At this point, the Department of Education has said, look, the taxpayer is on the hook as the federal government is the one who is backing these loans. And so they are reinstating the full requirement. If you haven't been paying your student loans, you're going to see consequences of being reported on your credit report and being sent to collections. Similarly, if we talk about the end of student loan forgiveness, really it's more like the end of pandemic era flexibility and leniency. During President Biden's term, the SAVE plan was introduced as a new repayment plan. That one is currently being challenged in court, and it is very likely that that plan will be ended either by the courts or by the Trump administration itself. Again, we're seeing consequences returning for not making student loan payments. And in general, there is a feeling from the current administration that they really do want to end student loan forgiveness going forward. That said, there's nothing to suggest that they can do anything to take it away from the people who have already earned it, which is why if we talk about what you can do in this environment, the most important thing is to talk about it. Talk with us, you know, uh, and Yusuf, if you could jump to the next slide. Um, connect with us if you have questions. We'll look at your specific situation and discuss whether you're on the right track for student loan forgiveness, if you should just continue to make timely payments, or if you need to consider a change to your repayment plan. Similarly, save a copy of any of the initial loan paperwork and all of the terms and conditions for your student loan, because what experts are saying is that the terms and conditions of your loan cannot change even if the agency overseeing it does. And lastly, continue making payments for as long as you're able. Keep detailed records of your payment history, especially if you're on an income-driven repayment plan. Make sure you know exactly which payment plan you're on, how many qualifying payments you've made toward that plan, because you want to be sure that, if you've reached the end of that 20 or 25-year payment period, that you can attest that you are, owed that forgiveness at the end of the period. The last thing I'll leave you with is the New York Times, the daily podcast on Monday, April 21st, was actually about student loan forgiveness and the current landscape, and it's worth a listen if you're curious about learning more. So
And
if there are any,
we'll send a link to that, right?
yes, and that will include in the follow-up as well. Are there any immediate questions? We'll hold for a few seconds and can address anything here. Otherwise, if you have questions about your specific situation, be sure to reach out to us individually.
I have one question coming in just around student loans for teachers, and I think that what we'll do is we'll answer this one separately offline since it's a more specific situation, and obviously there are different circumstances for private loans versus loans subject to the public service loan forgiveness. So I'll take a note of that one, make sure we connect offline about that one. And I'm not seeing any other questions yet. I'll keep an eye here for a moment and I did type in the chat, so hopefully everyone saw that, but Sydney and Ryan they each wrote really great pieces about these situations, about what's going on, the current updates. Those we will link on the page where we post the recording of this webinar. We will link both of those posts as well as this New York Times podcast that I was laughing with Ryan. I listened to on my drive into the office yesterday. It's great. There's some good stories and there's some good personal experiences and a lot of context on what's happened and what is happening, and keep an eye out for updates. This is as Ryan was starting with, a kind of a rapidly changing situation. And so as there are solid updates, you will see more from us in the Live Big Way Digest and in future webinars if the timing works out. Same thing with Sydney and the insurance market. We reached out to California clients about some of this. We're in progress of making some updates with clients, and we'll make sure that it's something that we talk about with everyone, because there's really good, what we call financial hygiene there, making sure first and foremost that your estate plan is up to date and reflective of your current wishes of the people and causes you want to support, the people you trust to make decisions on your behalf should you not be able to, and that the rest of your financial planning setup is in alignment with that estate plan and things are titled in the right way and beneficiaries are updated. So those are some financial planning things we're always thinking about and looking at when we're getting together for those meetings, and we'll make sure that we're touching base on those. So with no additional questions right now, we'll talk about, I just wanted to wrap us up with some talk about what we can control. Because as Yusuf said at the beginning, we haven't figured out a way to control the markets. We don't have a working crystal ball. If we did, I think we'd all be on some wonderful island enjoying the beach or some mountain skiing if that's your MO. But there are things in life that we can control. And I think it's really important to focus on those. Certainly personally, when things can feel chaotic, when it feels sometimes like a fire hose of information and change coming at us, and things that are just unknown and unknowable. But the things that we can control are our sources of resilience and your sources of resilience. The first one of those being cash planning. So you have an emergency fund, you have cash reserves, those things are there and available for you should something come up. One thing that I will comment on here is that for all of our clients who are spending from their portfolio, you have a full year's worth of your cash need in cash. And we top that up every 6 months. So that is available in there because we know that there will be volatility in the short run. We don't know what the market's going to do. And that's why our cash needs policy for anyone with cash needs is that known needs for the coming 12 months or so are in cash and available and there for you, not subject to any short-term fluctuations of the day-to-day roller coaster or whiplash, if is how I've been putting it, of the markets. Similarly, your stable reserve. So those of our spending clients, if you are spending, your stable reserve is in the form of that 1 year's worth of cash and the bonds in your account. And as Yusuf was mentioning, those bonds are very high quality, very short term in duration, not subject to significant interest rate fluctuations, not the 30-year bonds that you may have been reading headlines about in the last couple of weeks. And that 30% in bonds plus the year's worth of cash you have, it provides you what we refer to as a stable reserve. It will bridge you through a 6 to 7 year downturn of your safe spending target, where we could leave stocks completely untouched, allow them to fully recover, and bridge you through that downturn, because we know downturns will come. It's part of life. It's part of the game of investing. It's why ultimately we make money in the long run. We know downturns will come, so it's about having resilience and stability in the portfolio for those times, because we also know that the recoveries will come. So leaving the stocks alone to fully participate in that recovery. The other piece that is in your control is really your financial plan, and that is specific to each and every individual that we work with. There is, you may recall this if you've been on past webinars or if you read Yusuf's most recent piece, there's not a drop down in our financial planning software for which party is in power, which party is in the White House, which party is in control of Congress, what the specific political outcomes are coming out of Washington. There aren't drop downs for that, but we absolutely build in volatility because we know volatility will come for whatever reason it may be. And so you may recall, if you've seen your financial planning reports recently, or if you think back to some financial planning reports that we review together, you may recall what we lovingly refer to as the tornado chart, the Monte Carlo simulation. There are 10,000 different possible scenarios that the software uses to stress test your financial plan. And every single one of them picks a random rate of inflation and applies it to your costs, a random rate of return and applies it to your investments, and does that all the way to age 100. And that's one scenario. And it does that 10,000 times. And so that tornado chart ends up being those 10,000 possibilities and absolutely builds in what this possible volatility could look like. And so that is built into your plan. And as Yusuf was sharing, your portfolio is built for times like this. We know they will come. And so it's about the keep calm and carry on. And so sticking to it, thinking about, here I have Horizon. And this is one where I would say I'll circle back a bit to what I was sharing before, in that being positive and looking in the long run and looking out 6 months, a year, 5 years, 30 years, whatever your timeline is, whatever your view of the horizon is, looking to that positivity is not to negate what you're feeling in the moment and what the experience is for everyone. Your experience is unique to you. Your feelings are absolutely valid, and it has been chaotic. And as I think I said earlier, insert adjective here of how you want to describe what the last couple months have felt like. And we believe that we'll get through it. And we believe that there are things we can control that have really nothing to do with money, whether that's spending time with loved ones, going out for a walk, spending time in nature, whatever way you choose to make yourself feel good. For Yusuf, I know that is a daily date with his bike every morning to make sure that he has his endorphins running before the day goes. And that's unique to everyone. And so I want to wrap us up with what we always stand by, is that live big. Live big is unique to everyone, and it's about the size of your life, not the size of your wallet. And money is important. We certainly talk a lot about money and finances and economics. It is certainly one piece of the puzzle, but it truly is about the size of your life. And we love empowering you and being with you along the journey to figure out what that looks like.
Hear, hear.
Yes. Thank you, everyone. I'm feeling I'm gratified that so many of you joined us. And as I said, you will have a link shortly that you can share. You could, if you want to watch it again, you could certainly do that, but otherwise you could share it with friends, family, and colleagues. We encourage you to do that. And we also encourage you, as Lauren and Yusuf and Sydney and Ryan have all said, to reach out to us. If you have any questions about your individual circumstances, we're here and available and anxious to talk to you about it. So thank you very much. Have a wonderful day, and we'll talk soon.